them two options. I think it was very interesting and telling how he worded that. If you cannot give me a no-fly zone, then at least give me the materials to be able to protect the skies in Ukraine. That is something that already was getting a lot of Republican support, and potentially this speech is going to put a lot more pressure on Republicans to then put that pressure on in the White House.
Anne-Marie, thank you. Down in Washington alongside Maria Tadeo in Brussels today. Joining us now, Morgan Stanley's Jim Karen, PIMCO's Aaron Brown, and Jim Bianco of Bianco Research. Jim, I want to come to you. How the events unfolding before us in Europe, in Ukraine, and this relationship that Russia has with the rest of the world, not sure we can call it that anymore because there's not much of one, bar China. Jim, how does this set the stage for a Federal Reserve that somehow has got to make a forecast about what the future looks like in the US economy and for the world too?
Oh, it's going to be extraordinarily difficult for the Fed to try and figure out what they're going to go next. But the overriding thing that the Fed is going to focus on, I think, is going to be inflation. They've made it very clear that that is their priority right now. A growth, financial stability might have to take a back seat to it. And I think that the Fed is going to probably make the case that they're going to raise rates and continue to raise rates until inflation moderates. And if the economy has to stumble, as Chairman Powell said in testimony 2 weeks ago, history will show that they're ready to potentially put the economy into recession. I don't think a lot of investors are ready for that or want to hear that, but I think they've made that very clear.
Look at this banner, Jim Karen, that we're running right now. And I'm not criticizing the team at all whatsoever. This is a summary of the way markets are priced this morning and what people are saying about markets. This idea that talks between Ukraine and Russia are going well, try and reconcile that with the words of the Ukrainian president in the last 10 minutes, Jim.
Yeah, there's clearly a disconnect. I mean, what's happening on the ground in the Ukraine, as we've seen just now, is a complete tragedy. The markets are focused on, though, any marginal differences that they can really just hang on to. So in a bad situation, if things are getting marginally better, that shows that the delta is starting to change effectively towards, hopefully towards a brighter future. And that maybe this kind of a speech, this kind of a plea, maybe the upside in the futures markets and in the markets are maybe suggesting that, Russia's hearing this loud and clear, and they're realizing potentially that, the world is really against them on this stage. When we think about the Fed, though, I think that we have to understand their policy reaction function, and their policy reaction function is very clear, and it's basically that they need to keep inflation expectations anchored. So while this event is taking place, this tragic event, it is also creating a supply shock in the markets that's creating higher energy prices and higher inflation. And they need to address that, again, to keep inflation expectations anchored, and I can't stress that enough. So that's where I think the Fed's mind is right now.
Jim Karen, Jim Bianco, with us through the opening bell. Aaron Brown of PIMCO with us too. Going into that, futures are elevated, up by 1.28% on the NASDAQ. On the S&P, up about 1%. If you get to the bond market, yields shaping up as follows on a 10-year yield going into the Federal Reserve decision a little bit later. 216, yields up a couple of basis points. Euro-dollar firmer, approaching 110 through that level earlier, back down to 109.91. That currency pair up a third of 1%. And crude all over the place, 98.20 on WTI, up 1.8%. Somehow this Fed's got to make a decision today. We imagine they're going to be raising interest rates. From there, it's pretty simple, isn't it, Mike McKee? From there, you lift your forecast for inflation, drop your forecast for growth, and somehow tell me where the dot plot's going to be and where rates will be this year, next year, and the year after that.
Very simple, at least for the very short term, from maybe 2 o'clock to about 2:30 this afternoon. 25 basis point rate increase in the cards. That's going to happen. Then we get the new summary of economic projections and the new dot plot, and those are going to be very important in forming market expectations for what the Fed is going to do ahead. Now, the question is, what are they going to do ahead? And you look at the dot plot, and we've shown this before, you see that the market priced in less in tightening after the December meeting. They're pricing in a lot more now ahead of this March meeting. How far does the Fed go in that direction? That's going to be the kind of key question for people today. But can Jay Powell answer that? That's going to be the question for him at the news conference at 2:30. Can he tell us what Jim Karen was referring to, their real reaction function? I mean, what's going to make them move? How do they incorporate the war and what it may or may not do? And can they pull all this off? You go back to history and you look at the Fed trying to tighten, and almost every time we end up in recession. And Larry Summers made the case in the Washington Post today that what you're going to get is higher unemployment. That always happens when the Fed goes into a tightening cycle, except for that one in 1994. Every other time. So the Fed is going to put people out of work. How far do they have to go as far as recession to bring inflation down?
Mike McKee, thank you. Aaron Brown, you get that one. Typically over the last 10 years, the more we price in for the Fed, the less they're able to do. Spreads are wider, equities are lower, they back away. Is this time different?
No, I don't think this time is different. I do think, though, that the rate hiking cycle is complicated by inflation that we haven't seen, certainly in recent history. And so the Fed is trying to really walk that fine line by not tipping the economy over into a recession, but at the same time keeping inflation contained and bringing inflation down from very high levels. I think what's important to watch today are two things. One is, what is that terminal rate that the Fed is projecting? How much higher is that terminal rate relative to neutral rates? Remember, the Fed has said that neutral rates is at about 2.5%. So whether or not they really bring that terminal rate meaningfully above 2.5% is something that the market's going to be really focused on. The other thing to watch for market practitioners is what happens to the yield curve. Right now, we're going into the meeting at about 30 basis points. How that yield curve trades in 2s, 10s is going to be very important as a recessionary indicator for the market. And so as we start to see that move lower, close to zero and through zero, and eventually invert, that's going to be the key that the market's focused on, because typically 1 to 3 years after curve inversion is when the Fed rolls over into a recession.
Two pieces to that comment. Let's pick up on the first one, where the dot's head. Jim, I'm going to come to you on that and pick out, let's say, the 24 dot. The 24 dot right now is at 2.1%. Jim Karen, I caught up with Bill Dudley, the former New York Fed president, some weeks ago about this dot plot. He said they're in fancy land. How far north does that dot need to go?
Yeah, I think it needs to go considerably higher. I think that the dots are going to start to show that that the Fed is probably likely to get up to that 2.5% terminal rate, and the market expectations are, much of the consensus of forecasters are expecting that the terminal Fed funds rate is between 2.5 and 2.75%. There's a big disconnect because the market is actually pricing that it's just over 2%. So essentially, I think there's going to be an upgrade in their inflation forecast for core PCE and for headline PCE. Headline PCE running somewhere around 2.6% from the last summary of economic projections is probably going to be boosted up to about 4 to 5%. And core PCE is going to be boosted up to probably 3% or slightly above for the end of 2022. Now, this is interesting because these numbers are above their stated target of inflation, say 2 to 2.5%. So the whole key here is that if we're going to be above target, shouldn't the Fed do more to bring inflation back down to target? And if they don't do more, then what they're basically telling us is that they're going to allow the economy to still run hot and let these inflation pressures build for a while longer. Again, because I think it's temporary and it's driven by a supply shock.
Within the forecast, will we see an implied restrictive Fed? Jim Bianco, you sent me a message earlier this week. I read them all. You said, remember that exchange with Senator Richard Shelby. Are you prepared to do what it takes to get inflation under control? Powell said, I hope history will record that answer to your question is yes. Jim Bianco, are we really going to see anything close to Volcker today?
I don't know if we're going to see it today, but I think that the Fed is going to be on that path. I do believe that there's been a rethink at the Fed and that their priority, as I said before, is inflation, and they're not going to shy away from being aggressive in dealing with higher prices, especially when it comes to the political aspects of higher prices moving higher. The March CPI number is going to be another blowout number on the upside because of the rise in gasoline prices for the month alone, not to mention agricultural prices as well, too. But over time, I think Powell will go back to what he said in December when he was asked about raising rates aggressively, and he pointed out in the JOLTS report, there's 4.5 million more jobs available than there are unemployed. That implies he can get really aggressive without worrying about creating that unemployment that Larry Summers fretted about today. That's in their mind, that's a ways off, and they could really start going, because I do believe it's all about inflation and growth takes a back seat.
6 minutes into the session, ahead of this decision, the equity market advances up more than 1% on the S&P and the Nasdaq up 1.6. With your movers around the open, here's Abby.
Well, John, we are having this second day of a rebound rally. The S&P 500 gained 3% over the last 2 days, the best 3 days in 2 days in 3 weeks, and it's a broad-based rally. One of the top stocks for the S&P 500 is Apple, up also for a second day. Buy the dippers come out, even with rates higher, and of course rates higher, that's helping out the banks. JP Morgan up 1.9%. And of course, we have that monster rally in China. The Hang Seng up more than 9%. Its best day since 2008. Las Vegas Sands, the casino operator, more than 70% of their operation, their revenue comes from Macau. That stock up 8%. But take a look at Alibaba, some of these other tech ADRs. Those are the real winners in the tech rally. Alibaba this morning up 15.44%. Of course, after that more than 70% drop. But the question is that a real buy the dip for the long-term rebound, John? We'll find out.
Abby, thank you. Earlier on this morning, literally 30 minutes ago, we had an emotional plea from Ukraine's leader for more help on the military front. Interfax reporting the following just moments ago. Russia asking the US to stop weapons supply to Ukraine in a call. That coming from Interfax, the Russia asked US to stop weapons supply to Ukraine in a call, and that line comes just moments after we heard from Ukraine's leader. Vladimir Putin, according to TASS, saying the following: Ukraine operation successful and in line with plans. Still calling it an operation, the rest of the world calling it an invasion. Ukraine operation successful and in line with plans. The word from the Russian president just moments ago. Big move in this equity market through much of this week. At one point, the Nasdaq 100 closed in a bear market, and then we had a big bounce back. With that bounce, here's Kaylee.
Drama, John. It's nothing new for this year, but it really has been quite a turnaround for technology in particular. Granted, the gains of yesterday only go so far to help recover the losses that the Nasdaq 100 has seen this year. It's still off 16% on a year-to-date basis, as we've seen this really dramatic rotation out of technology and growth names into value. But that was not the case yesterday. It wasn't just the Nasdaq that was moving. The S&P Growth Index actually had its best day relative to its value counterpart. The third time we've seen it moving by a margin of 1.5% of outperformance in the last 3 weeks. Though obviously, as we can see on the chart, that hasn't been consistent throughout the year. Another point I would make about yesterday, the only sector that actually ended the day in negative territory was energy. Of course, a classic value play, down because oil was down and down hard. WTI back below $100 a barrel, more than 20% off of its recent peak, north of 120 just on March 8th. So yes, in a technical bear market in the span of just about a week, even though it's still up some 30% on the year. And since that March 8th peak, we have seen some big losses for energy companies as well. The biggest losers since then, Schlumberger and Exxon, each down some 12%, and other big North American shale players like Marathon, Coterra, Devon, and Diamondback, all among the big laggards as well, John.
Kaylee, thank you. This bounce in tech continues at 1.7% on information technology in the early part of this session, at 1.4% on the S&P. Erin Brown, any reason to believe that's the direction of this equity market you should be leaning?
Right now, I think that the outlook is pretty unclear for equities, and I think that while the market's pricing in about 40% equity, sort of recession risk going into the end of 2022, it's still pretty early, and I think that the outlook is going to remain pretty volatile. That said, I think there's been some really high-quality companies that have been, trading and hit pretty hard as a result of the conflict and, the risk of recession moving higher. And I think that it is time to start dipping your toe into certain sectors of the economy that have sold off, and will continue to do well, I think, because of the quality. But I do think that overall for the market, until we get more clarity with regards to the conflict and more certainty about the outlook for the U.S. economy, I do think that the environment is going to remain exceptionally choppy. That said, again, I think looking for quality within portfolios makes a lot of sense right now, and there are some really good high free cash flow generating companies that have been, trading down in excess of 10% that offer real value here.
A ton of news this morning, so I appreciate the patience of all three of you as we work through some of this. Jim Bianco, the final word goes to you, sir. This line here, the LME says electronic trading in nickel to reopen at 2 p.m. Jim, I know you've got things to say about this. Here's your opportunity.
Yeah, it's unfortunate what's happening with the LME, and that the way that they've been changing their rules and bending their rules for the benefit of a few at the expense of many. And it's a broader problem in the commodity markets right now that quite frankly, they're pretty dysfunctional in the way that they're trading. And that's what you're seeing, in the headline one with crude oil as well, too. I hope that over the next couple of weeks or months, we're going to start to see some normality return to those markets and maybe some confidence that when you do a trade in those markets, that trade stands and that they won't come back and cancel it because it is inconvenient for other players that we had prices at levels that they didn't want.
Jim Bianco of Bianco Research, Jim Caron of Morgan Stanley, Aaron Brown of PIMCO. To the three of you, thank you. We heard from Zelensky a little bit earlier this morning. Vladimir Putin right now on a televised meeting with officials saying the following: we will not let Ukraine become a base for attacks on Russia. The Russian president's words just moments ago. Earlier on this morning, Ukraine Zelensky making an emotional plea to President Biden to do more.
I wish you to be the leader of the world. Being the leader of the world means to be the leader of peace.
That's next. This is Bloomberg.
As the leader of my niche, I am addressing the President Biden. You are the leader of the niche of your great nation. I wish you to be the leader of the world. Being the leader of the world means to be the leader of peace.
A deeply emotional plea from a wartime president before Congress in the last hour, asking for the US to help them close the skies, asking for more sanctions. The sanctions already hitting Russia. Russia teetering on the brink of default with $2 bond payments coming due today. Fitch Ratings saying the following: the payment in local currency of Russia's US dollar euro bond coupons due on March 16th today would, if it were to occur, constitute a sovereign default on expiry of the 30-day grace period. For more, I want to bring in Damien Sassower. Damien, you and I have talked about two issues all week. One was this one: what currency would they try and pay it in? And two, what would happen if they tried to pay it, but the money didn't actually reach the end investor?
And Jonathan, that's exactly what the Russian finance minister Sulanov is expressing he's trying to do. He's trying to make payments in dollars, but because Euroclear and Clearstream have effectively blocked all transactions, he can't do so. So what they've tried to do is create these Type C accounts which investors can open in order to take receipt of funds. But again, these are Russian accounts that are effectively blocked from doing any transaction. So you couldn't get your dollars out of Russia anyway. So far be it for me to decide whether or not a best effort case on the part of Russia to make payment constitutes a default given the logjam we're seeing. That's not my call, but for all intents and purposes, if you just look at other Russian corporates like GTLK, March 10th, they had a coupon payment of I think 14 million owed. They finally just made payment today. So, Russian corporates like Gazprom, like Rosneft, Russian railways, they are making payments to their dollar creditors. As it stands, no one has defaulted, but the key element here is they want to see their central bank reserve assets unblocked in order for them to start doing that, and I just don't see that happening, especially after Zelensky's case today in front of Congress and all that's going on and the war repatriations that are come hand in hand with that.
Damien, traditional metrics just don't apply anymore. Typically we'd think about ability to pay or willingness to pay. On the ability to pay, they're saying they have the ability, they just can't access the money because the reserves have been sanctioned. On the willingness, they're telling us this morning they're trying. And still, the end investor doesn't get the cash.
Yeah, well, willingness takes on a whole different meaning when you're in this environment, right, Jonathan? Willingness might very well mean they need to pull out of Ukraine in order for their, central bank assets to be unfrozen so that they can actually make payments and return to the international community. That is not happening, and it's certainly not happening anytime soon, and it's certainly, in Jonathan, in my mind, not happening within the 30-day grace period.
All these talks continue between Russia and Ukraine. Another headline from Ukraine calling for a ceasefire, a withdrawal of Russian troops at the same time. Talks, I'm told earlier this morning, Damien, maybe a breakthrough on the issue of neutrality. Then China came out of the gate.
Yeah.
And we got a massive lift. That verbal intervention, walk through it for me. How important was that step that we got? Just a couple of words will basically do what we need to do.
Well, Liu He, who, as you know, runs the Financial Stability Board in China, it's the highest-ranking economic committee, basically addressed all four major concerns held by foreign investors in China. They addressed the property sector, they addressed the crackdown on big tech, they addressed the ADR issue here in the U.S., they addressed stability in capital markets by hitting on all four of those buttons all at the same time. They'd never done that before. So yes, it is significant, but at the end of the day, there's no conditions attached. There's no policies attached to that. We don't know how China is going to create additional stability in the capital markets. And so it all really goes out the door in my time. Again, if you look at what happened, it was the move into dollar yuan. Look, we saw the stock market crashing. We've seen that before, but it was the move in dollar yuan that caught everyone's attention. And given all of the foreign investment we've seen over the better part of the last 3.5, 4 years into China, I think that's what irked them the most. And I see, I don't want to say plunge protection team again, Jonathan, but
yeah, well,
it smells a lot like that.
I was thinking that this morning. Damien, just quickly, what do you think's easier, to forecast the Chinese equity market or crude? Which one?
Oh my God, I think the Chinese equity market is probably a little bit easier. Crude, again, I said this on the record before, that is a man's contract. I stay away from them.
Here we go. Should we get to a man right now, Javier Blas of Bloomberg. Javier, explain to me how a couple of Sundays ago we were looking at 140 on Brent and now we're looking at 100.
Can I not talk about the Chinese equity market
We can
instead?
do that instead. We can do that instead. Talk about crude, Javier.
Crude, a couple of things have changed since the last 10 days. One is COVID in China, and we are beginning to see signs that Chinese drivers are not hitting the road, and that is really spooking the oil market. Also, the potential of an Iran nuclear deal is increasing. We are seeing the release of some British nationals who were kept in Tehran, and that could be the anticipation of Iranian deal coming. So we may have a bit of lower demand, we may have a bit of extra supply, and that is comforting a bit the market. And there is a lot of the plumbing of the commodity market. Is simply not enough credit for every commodity trader to play in the market right now. Everyone has taken risk off simply because they were spooked by margin calls in particular, and that is really keeping the market a bit lower than we were a week ago.
Javier, just quickly, in about 30 seconds if you can, given the new price limits on, say, the LME on nickel, how messy is it and how long will it take to sort out because of just that, their new rules?
Well, it's going to take a few days. I will not be surprised that we are a full week, all the days hitting the limits. But the LME is trying to widen the price limits. At the moment, it's only 5%, and the LME is trying to increase that so we can reach a market price in a fewer days that otherwise will take. If not, it's going to take probably at least a week.
Jim Bianco of Bianco Research with some strong words, strong thoughts on this topic. Javier, great to catch up, buddy. The harder job versus, say, Damien Sassa, who just has to work out what constitutes a default on Russian debt if they pay and it doesn't reach the investors. I think it's pretty complex all round. Damien, Javier, thank you. The President of the United States, 11:45. He will deliver remarks on Ukraine. Look out for that. Want to get you some sector price action. Here's Kriti Gupta.
Yeah, good morning, John. Let's see a pretty broad rally this morning. You are seeing a lot of green on screen. The only sector in the red is going to be those utilities, financials, information technology on the top. And you can see a lot of that has to do with higher yields in anticipation of the Fed later today, but also information technology really thriving off of those comments from China. You just talked to Damien about it. The idea that more capital liquidity is being brought into the system, which of course affects those supply chain, semiconductor stocks, Apple, Microsoft, those are all helping the bid today. That being said, let's talk about what's moving to the downside, and that of course is going to be your defense stocks. Lockheed Martin is a major move to the downside. As we know, that in the past couple of weeks you have seen those defense stocks really rally, but today Lockheed Martin actually getting some reporting that the Pentagon is only going to increase their F-35 purchases by 61 jets. That is 33 less than expected, and on top of that, potential talks between Russia and Ukraine pressuring that sector, John.
Kriti, thank you. We've talked a lot about Ukraine's perspective, Russia's. Here it is, Vladimir Putin. Russia is fighting for its sovereignty and its future as they invade another country, and the leader of the other country is pleading for help from the United States. We'll hear from the president a little bit later. A lot more on that trading diary next. 26 minutes into your trading day, up 1.4% on the S&P, on the Nasdaq up 2 percentage points. A rally going into the Fed decision a little bit later. That's the price action. Here's the trading diary. Coming up before that, President Biden on Ukraine, 11:45 Eastern. We'll take that for you. Russia's coupon payments on $2 bonds due today. Plus, it's a big week for central banks. The Fed kicking it off. A rate decision at 2 p.m. A news conference shortly after that. Then it's the Bank of England's turn. Alongside the ECB, we'll hear from Lagarde. And finally, rounding out the week with decisions from the Bank of Russia and the Bank of Japan. From New York, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Wednesday, March 16th. Here are the top market stories we are following for you at this hour. Pleading for peace. Ukrainian President Zelensky makes an emotional plea to Congress, asking for help to defend his country's skies. Meanwhile, Russia says a neutral Ukraine with its own armed forces could be a compromise, hinting at possible progress in talks. Decision day, the Fed is set to hike 25 basis points today. We know that. What will matter, the dot plot, the projections, and Powell's news conference. We'll preview it all with Bruce Richards of Marathon Asset Management. And Plunge Patrol, Beijing swoops in to intervene in the sell-off in Chinese assets, pledging support for financial markets and the economy. It boosts risk sentiment in Asia and around the world. From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, while it is Fed Day, Chairman Powell will be taking the podium later. It was President Zelensky who took the podium first with an impassioned plea to Congress.
Absolutely. A standing
Russia
ovation.
has turned the Ukrainian sky into a source of death for thousands of people. Is this a lot to ask for, to create a no-fly zone over Ukraine to save people? Is this too much to ask? Humanitarian no-fly zone.
Joining us now, Kayleigh, Bloomberg's Washington correspondent Amory Hordern. She joins us from Capitol Hill. Amory, the call was clear. Shut the skies or give us aircraft. How is the U.S. going to respond?
Well, we're going to be hearing from the president, Guy, as well, just before noon today in Washington, D.C. And really, President Zelensky there made this plea at the end, speaking in English directly to the president. His tone and sentiment, obviously, incredibly emotional, imploring Congress to act to ratchet up the pressure on the administration. But it was interesting, when he renewed his plea for that no-fly zone, he said, if that is too much to ask, then give us the air defense we need so we can protect our skies. And this all became, as well, came before he showed a really graphic, horrific video showing exactly what is going on the ground in Ukraine, and then that ended with a black slate just asking Congress yet again to close the skies.
Yeah, Anne-Marie, it absolutely tugs on the heartstrings. So let's talk about how Congress would respond. Is it going to take congressional pressure to get the Biden administration to move on this?
It potentially will, and we've already seen some of that. When it comes to a no-fly zone, there is bipartisan support to not go there yet. President Biden has said this would mean World War III. Jen Psaki was asked about this yesterday, briefing the press, and the message from the White House is that they believe this would be escalatory, and that Russia would view that as the U.S. or a NATO member entering this conflict directly. But when it comes to sending them those Polish fighter jets, there is already some Republican support for that, and I imagine the pressure is just going to be ratcheted up after this really emotional plea from President Zelensky.
Amory, we understand that there's also been a conversation between the Russians and the Americans regarding weapons being sent to Ukraine from the West. The Russians wanted to stop. Is there any chance that happens?
I don't see that happening, as the president just before noon is going to talk about the military aid they are sending to Ukraine and the billions of dollars they are helping Ukraine in terms of not just military but also humanitarian efforts and economic efforts. This call, we have yet to hear the U.S. readout. All we know right now is what Interfax is reporting. But we spoke about this yesterday on this show. Jake Sullivan, the president's national security advisor, was seeking a call with Nikolai Patrushev. That is his counterpart in Russia. He is the secretary of Russia's National Security Council, and what the United States was seeking that call was to warn the Kremlin about the use of chemical and biological weapons. Right now we're hearing just from Moscow is that Russians have asked and warned about stopping supply to Ukraine.
Anne-Marie, we've talked a lot about potential aid that the U.S. could give in the ongoing conflict. Let's talk about the role it could play in eventual peace, perhaps. We had the Kremlin earlier saying that a neutral Ukraine with its own armed forces could be a compromise. Ukraine saying it needs security guarantees. What role would the U.S. feasibly play in that?
Well, I imagine the U.S. would play a role in terms of security guarantees. That's what Ukraine would ask for, security guarantees from NATO, which the United States is part of potentially. But we should note, when it comes to the diplomacy, there are tons of headlines coming out from Moscow, from Kiev, and they are in the middle of these negotiations. We need to be very careful with how we read, especially the markets, how they read any of these signals and potential posturing from both of these channels. And we should note that it is hard at times to take the Kremlin at face value, given the fact that you just have President Putin right now also on state TV talking about the need to protect a sovereign Russia as Russia is invading a sovereign country of Ukraine. We should also note, weeks before the invasion, for weeks, the Kremlin had maintained that they had no plans to invade Ukraine. Obviously, we know that is not true.
Anne-Marie, final quick question. Congress looked united today. Does it extend any further than simply the U.S.'s response to the Ukrainian crisis? Is this going to be a pivotal moment politically, domestically in the United States?
It is a pivotal moment domestically when it comes to this issue, Guy, and I think you bring up a really good point. It's this issue that has brought Republicans and Democrats together. Yes, there are fractures in that relationship even when it comes to this issue. Yesterday we heard from Senate Minority Leader talking about yesterday, McConnell talking about the fact that he thinks the administration is dragging their feet. And remember, when the White House came out with the import ban on Russian crude and other fossil fuel products, that really was pushed ahead, and the pressure came from Congress, from Capitol Hill. But right now, they are united when it comes to Ukraine. I don't see that at the moment extending to other domestic issues.
All right, so we'll see how pressure from Capitol Hill regarding those jets and other issues that Zelensky has raised today may come forward. Thank you so much to Bloomberg's Anne-Marie Horton reporting from the U.S. Capitol. Now, coming up in just a few hours, we'll find out how aggressive Fed policymakers are when it comes to fighting inflation amid an ongoing war in Ukraine. We'll get a preview and the perspective from Citigroup's global chief economist, Nathan Sheets. This is Bloomberg.
Inflation.
Highest since 1982.
War.
This is the central banking nightmare because there is no good answer.
Everyone is eyeing the Fed's next move.
We are getting whipsawed.
I think they have to move.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The market is pricing 50 basis points. The Fed should walk through that door.
Look for massive adjustments.
It's going to be a very delicate task.
Bloomberg Surveillance. The Fed decides. Today on Bloomberg. The fastest way to stay one step ahead.
The Federal Reserve is set to raise interest rates for the first time since 2018 later today. Policymakers all but certain to boost the rates by a quarter percentage point at the end of their two-day meeting. Joining us now, Citi Global Chief Economist Nathan Sheets. He's a former Treasury Undersecretary and was Director of the International Finance Division at the Federal Reserve. Nathan, 25 basis points is the move. Chairman Powell has all but directly told us that. So what could constitute a hawkish surprise out of the Federal Reserve today?
I think this is a defining moment for the Federal Reserve, and I agree that the question is not so much where does policy go. The 25 basis point move has been well telegraphed, but I think it's about tone, it's about analysis, it's about the Fed's take. How worried are they about stagflation? On the one hand, yes, inflation is running hot. On the other hand, we're also seeing a massive increase in global economic uncertainty, and stress is arising from that. And how does the Fed balance those challenges? So I think here hawkish would be more of an emphasis on the inflation risk that we face and a downplaying of some of the growth implications of this episode.
Nathan, presumably at some point high inflation will impact growth. How do they deal with that?
Well, they say that, the best cure for high prices is high prices, but that happens through demand destruction. And I would say that with inflation running at the pace that it's at, that's a risk going forward. That said, for the moment, it feels that the consumer in particular has continued to be pretty well positioned to be able to manage through the price increases as a result of the hot labor market and also strong balance sheets. But that may be ultimately where this thing lands, is particularly some of the higher commodities and materials prices end up being a tax and a headwind on spending, and the economy in some sense kind of cools itself. But that's probably 6 to 12 months down the road, I would say. I'm not sure the Fed wants to wait that long to get some traction on this problem.
All right, so demand destruction may be a little bit farther away. Obviously, when it comes to inflation forecasts, we will get new projections out of the Fed today. We will also get a new dot plot. Nathan, what matters more, the number of dots in 2022 or the terminal rate all the way at the far right side of the chart?
I'd say they're both very important. My expectation is that the Fed will be hiking rates most likely at every meeting in 2022. I'm not sure that they're going to be willing to admit that in their dot plot, so maybe it's 5 or 6 hikes. But I do think that's important. But I also think that terminal rate is something that longer-term investors, particularly in the bond market, watch very closely. And if we were to see that in this episode migrate up, I think the long end of the yield curve would definitely notice that, and that could be a source of volatility. I would be surprised if we saw at this point any meaningful shifts in that terminal rate, but if it happened, it would be quite significant.
Nathan, you talk about volatility. You're an expert in building economic models. How is your economic model coping right now with the kind of volatility that we're seeing? The inputs are all over the place. Oil is just one of them. Huge volatility there, but you're seeing it in other inputs as well. What are you getting out of the model right now? What are you putting into the model right now? How effective is it in terms of giving us an idea about where we go from here? What I'm really asking is, how much certainty do you have about the course that the US economy is on?
I don't want to overstate, but I think in this environment, when there is such a potpourri of shocks, we're looking at energy shocks. We're looking at a massive increase in just global uncertainty. At the same time, we're still fighting a pandemic, and we're worried about lockdowns, even as we speak, in Asia. That the guidance that our models can give us are very, very limited, and I think that we're going more right now just by gut instinct and thinking about, well, what are some plausible scenarios? And one scenario is there's enough momentum to get through this, and that the global tensions are resolved fairly quickly, and the global economy is able to go on its way again, maybe with a half point or so less growth than we were expecting a few months ago. But I think we've also got to substantially mark up our probabilities of global recession, and that there are various other kinds of nonlinear shocks.
If I could just jump in there, what do you see currently, given, yes, how cloudy and uncertain things are, the probability of that recession is?
For the global economy, I think 1 in 3 that we see a very marked and sustained slowdown in global growth. I think the reality is that Russia and Ukraine are big materials exporters. And to the extent that tensions there are persistent, the disruptions in materials supplies could be very, very substantial. I would say that the United States is probably a degree removed, and maybe the probability here is a little lower, maybe like 1 in 4. But if, as Greenspan said once, the United States can long remain an oasis of stability. So if we're seeing these big shocks in the rest of the world, the U.S. has more momentum, but it wouldn't last an appreciable period.
Nathan, if we see increasingly the global economy retreating from globalization and falling into spheres of influence that are going to impact supply chains and trade routes, are we moving into a world of structurally lower growth, structurally higher inflation, and higher rates?
Guy, I think the deglobalization in the aftermath of this string of shocks that we've seen goes back to the trade wars, the pandemic, the disruptions in supply chains, and now this ongoing geopolitical situation that we have. I think the prospects for deglobalization are meaningful. And as we deglobalize, that means fragmentation. And fragmentation suggests less efficiency for the global economy. And the implication of that would be softer, weaker global growth. Now, parameterizing all of those effects is very hard. What exactly, how much weaker? But, could it be a quarter percentage point weaker? Absolutely. And if you think about that relative to baseline growth of 3 or 3.5%, and aggregate that up over a number of years, it's quite substantial in terms of human welfare.
On that note, that slightly gloomy note, Nathan, we will leave it. Thank you very much indeed for your input today. Really appreciate it. Nathan Sheets of Citi, thank you very much indeed. What have we got coming up for you next? The clock is ticking on Russia and some of its dollar debt. One ratings firm is already warning that Moscow is on the verge of a default. We will talk about this next. This is Bloomberg.
Talking about that all day yesterday.
I just want to draw your attention to the front page of the Financial Times right now. I know we probably shouldn't be pointing in that direction, but let me do it anyway because it's having a market impact. The front page of the FT website says that Ukraine and Russia, Kayleigh, drawing up neutrality plans to end the war. How exactly that is going to work, we don't know, but the FT is pointing to a 15-point draft plan that would involve Kiev renouncing NATO membership ambitions in return for security guarantees. The devil is going to be in the detail in all of this. There was a report coming from a Ukrainian aide a little earlier on saying that this is where the talks are. It's about security guarantees. But we are seeing a market reaction to this. We are seeing yields picking up, the dollar down on the back of this report, Kaylee. It does sound as if maybe this is the direction of travel at the moment. But as we've seen before, details matter. And I imagine every single one of those 15 points is going to be debated very closely.
Yeah, absolutely. I would note that in terms of the market reaction, Guy, you're also seeing it showing up in oil. It's been fluctuating throughout the day, but sending it back into negative territory on the prospect that potentially a plan to end the war would mean less supply disruption. And then you're also seeing stocks at session highs. I know we barely blink at a 3% move anymore, but that's how high up Europe is on the day. And the NASDAQ 100 is getting near that territory, Guy.
One of the interesting aspects to all of this is, were we to see some sort of a ceasefire, and it appears that there's a lot to talk about here, were we to see some sort of a ceasefire, what would that mean in terms of the sanctions that have been imposed on Russia? What would it mean in terms of Russia's isolation from the global financial system? This is obviously a key question today. This as we wait payment on some key dollar bonds that Russia has coupon payments due. We've got a euro bond due as well. The rating agencies are making it very clear that a payment is not made, that we will see a default. Let's try and get an idea of what is happening here. Joining us now is our Chief Emerging Market Strategist over at Bloomberg Intelligence, Damian Sassower. Damian, the understanding at the moment is that a euro bond payment earlier on was made, but the financial plumbing didn't allow it to be paid. Can we assume that the same thing is ultimately going to be happening here when it comes to the dollar bonds as well?
Yeah, so let's take a step back. I mean, look, to be very clear, I've talked to a lot of investors. OFZ's Russian local debt, coupons have had to been paid on that. They haven't been paid yet. So Guy, I know the local bonds are a little bit different, but Russia's still not paying its foreign creditors the rubles that they're deserved. So now going to the dollar bond market, Russian corporates from GTLK, Russian Rail, Gazprom, Rosneft have all paid principal and coupons to their foreign creditors in dollars to date. Today's $117 million in coupon payments that the Russian government itself owes to dollar creditors is under discussion. And what I'm hearing is Finance Minister Sulanov is trying to make that payment, but because Clearstream and Euroclear have cut Russia off from the global payment system, they cannot make that payment. Yeah. So what they tried to do is create these Type C accounts where foreign creditors have to open up an account in Russia in order to collect payment, but once it's there, they can't repatriate those dollars. So it's a blocked account effectively. So this is what creditors are trying to wrap their brains around here on a Wednesday morning.
Right. It's not that Russia doesn't have the money. It's just that it can't use it. Now, correct me if I'm wrong. If they do indeed default, there is a 30-day grace period.
Correct.
So could we see things change during that time?
Absolutely. Well, GTLK didn't pay until yesterday. Their payment was due on the 10th. So yes, they're all kind of trying their best to get what dollars they can, either offshore, however they can get their hands on it, get it into the clearing system to make payment to their creditors. But yeah, I mean, it's going to be an interesting 30 days for certain, given some of the headlines that, Guy is rightfully pointing out here about, maybe a little bit of a de-escalation in Putin's war in Ukraine.
Were there to be a default, Damian, what would be the long-term implications?
Well, I think the long-term implications are clear to me, Guy. I mean, Russia is a pariah. Investors are not going near it. In fact, the last print we saw on many of these bonds, including the bonds that are due today, were 20 cents on the dollar. My sources are telling me that, big fund managers have marked those bonds all the way down to 5 cents on the dollar. So, clearly people, investors are preparing for the worst case scenario.
Well, talking about maybe not the worst case scenario, let's shift to one of the other markets I know you watch closely, and that is China. Yeah. What are your thoughts on the verbal intervention we got out of Beijing overnight?
Well, it's interesting because it's the first time that China's highest economic and finance head basically made where he addressed all four major issues affecting investors all at once. And so I'm talking about stable capital markets, the ADR issue here with foreign listings, property curbs, the crackdown on big tech, all at once. What's interesting here, though, for me is, that big rip we saw in Chinese equities, you could, call it a short squeeze. You could call it plunge protection buying. You can call it a lot of different things. At the end of the day, markets were severely oversold, not just in China, but globally. So I think a lot of this is kind of, I don't want to say a dead cat bounce. I hate that word. But yeah, I mean, maybe a little bit of bloodletting here was in order.
Damian,
Is there any action behind these words? Just very briefly.
Well, Guy, I do not see China adhering to to FASB, to the U.S. Accounting Oversight Board, as it relates to many of the companies that are listed in ADRs here in the U.S. I just don't see that happening anytime soon. There's been no real progress on that front, despite what you would hear otherwise over the last 24 hours. And I think that's a real key issue here. And that's why you're seeing the Golden Dragon Index, why you're seeing ADRs really still under pressure amidst it all.
All right, Damian Sassower of Bloomberg Intelligence, thank you so much for your great expertise. Now, coming up, we'll talk about China. We'll also talk about the Fed. The CEO of Marathon Asset Management, Bruce Richards, is joining us next. He thinks the Fed will move 8 times this year. What that means for credit. This is Bloomberg. We're an hour into the U.S. trading session. Bloomberg's Abigail Doolittle is tracking the moves. Abigail, we still have a while to go until that Fed decision, but the equity market is already making its move.
It is certainly making its move, Kaylee, and it looks like it may stick. We have this relief rally in place for a second day. In fact, the S&P 500 right now on pace for its best 2 days since the end of January, up more than 3.5%. You can see also nice gains for the NASDAQ 100 and the stocks, but it is this Golden Dragon China index that Kaylee and Damian and Guy were just talking about. It is extraordinary, up 25% in 1 day. To my memory, I cannot remember another index up 25% in 1 day. That's the best day ever for this index, not surprisingly, on that rebound. Whatever's behind it, the oversold, the talking out of Beijing, relief rally, there it is for sure. Now, of course, the Fed is ahead. Let's take a look at the 10-year yield because it is up a little bit on the day, but over the last several days, there's been this massive backup. It does look like there could be some consolidation. You can see roughly an up uptrend here, and then you can see a range. It would not be surprising to see the 10-year yield fall back toward the bottom of that range around 175. Should that happen, it might suggest the Fed could somehow, in some way, be a little bit more dovish than what investors are looking for, even if that does include the one rate hike that, of course, everybody's pricing in, and a chart of the S&P 500 that we took a look at last week that shows a bullish divergence may also support this idea that the Fed could be dovish. Take a look at the RSI, or momentum indicator on the bottom. We see higher lows. The S&P 500 has these lower highs. That bullish divergence may suggest you could just see that S&P 500 on the bullish momentum guy climb, let's call it 45, 4,600. It'd be a nice relief rally in what does seem to be, though, a more bearish context on the year.
Absolutely. How dovish, how hawkish will the Fed be tonight, Abigail? Key question. Let's try and get an answer to it and figure out where we go from here. The last time we spoke to him, he said he expected 8 Fed rate hikes over the course of this year. Joining us now is the chairman and CEO of Marathon Asset Management. He, of course, is Bruce Richards. Bruce, great to have you on the show again. Talk to us about where you are in terms of expectations for the Fed right now. You've been pretty hawkish in the past. You expect Jay Powell to be hawkish tonight. What do you think is going to happen?
It's pretty remarkable. I mean, think back just a second to reflect. It was exactly this meeting, exactly 2 years ago, March of 2020, when Powell brought down rates 100 basis points and embarked on a QE easing program that led to $5 trillion of printing of money. And so here today we are with inflation raging, out of control at 8%. We've never seen ever in the history of this world rates at zero with inflation raging like this, having gone from sub 2 to 8%. So the Fed is so far behind the curve. I think what he says in his language is going to be to calm markets, but what he has to do is control inflation. And so every meeting this calendar year, he's going to have to raise rates.
Well, Bruce, if the Fed is as behind the curve as you say, will 25 basis point hikes do the job?
But he's already showed his hand. He's already told you at his last correspondence that, which is, I don't think you're supposed to, show that hand then, but he did. He said 25 basis points. So that's in the market. That's what we all expect. That's what it will be. But what's more important than that is kind of what comes next, which is a tightening at every Fed meeting over the course of the next year. And in one calendar year, you have 8 meetings. And so there's 7 left this year. So every meeting this year and into next year, a tightening expected to get Fed funds where it should be, which is 2 to 2.5%. And mixed in there, you'll see a couple 50 basis point increases. And, you know how bad inflation is when even Tom Brady comes out of retirement, right? So
don't get me started on that, Bruce.
But it's not only Tom. It's like every household's feeling this. It's food, fuel, housing, all goods, all services. Every company on every company call we talk to, is talking about inflation. And talking about their cost of inputs, cost of manufacturing, cost of labor, and so it's spilling through. And what I say also, Guy Cayley, is that when you have the first, second, third, and fourth, it's not going to be problematic for the markets. When you have that fifth, sixth, and seventh, that's when the financial conditions tighten enough, and that's when the pain's going to be felt in the marketplace. So when I think about markets, I look at the equity markets, where they are now, properly priced at, say, an 18 multiple. I think for the high for the year won't get you back to where you started the year at 4,800. I think it'll probably get you around 45 or 4,600. You're supposed to sell into that. I think at some point this year, later this year, as conditions really tighten, you can look at wiping out all of 2021 gains, which is getting the S&P back down to 3,800. As it relates to credit, it's the worst start for credit and the worst start for fixed income that we've seen ever, with high yield down 6% thus far, IG down 9%, emerging markets down 12%, and there's also really good opportunity with the coupons that they provide to be able to buy credit at very, very cheap valuations.
Bruce, when we talk to the asset managers, when we talk about the idea that you should still be fully invested, they say absolutely 100%. You need to be fully invested in this market. When you ask them about cash and how big a part of your portfolio should be cash right now, they pull a face because they say that you should not be in cash. What do you think cash does to a portfolio right now? Do you want to be in cash? How much cash do you have? What are you thinking about when it comes to cash?
Well, in the public markets, in the credit markets, our book is yielding in the liquid markets, 5, 6, 7%. And you take a look at emerging markets, when you take Russia out of emerging markets, which comes out of all the indices at this month end, you're talking about being down 12% on the year with a 7% type coupon. And so we think when that market recovers, it could be up 15, 20% total rate of return. That's the liquid markets. In the private credit markets, because we provide a lot in the private credit markets in the form of, lending and in the form of capital solutions. And I think buyouts is going to be a big year because equities are down in the leveraged loan market, floating rate assets people like. And so we're able to provide all kinds of financing to the buyouts. And so I think it's going to be a big year for buyouts in private equity because of attractive multiples and how open the leveraged loan market is. And so our capital solutions business, our asset-based lending business is a double-digit type return with very low volatility. And so I wouldn't be in any cash. I'd be taking, any cash I have and finding private investments, both in private equity and in private credit, and deploying cash that way. As it relates to the liquid markets, look, you have to be able to trade. I think this is a trader's market. And so I think there's times to be in cash. And when the equity markets go up, and you're talking about 4,600 S&P, you're supposed to let go of a portion of your equities because you'll be able to buy them back 15% lower before this whole Fed tightening cycle is over. So I think it's a trader's market, a lot of volatility. Cash isn't going to earn you anything. It's going to get eaten by inflation. There's a lot of very smart things to do.
All right, Bruce, so if you don't want to be in cash, another place where it hasn't been fun to be for the last couple of weeks is anything that touches Russia. What can you tell us about your Russian exposure?
Well, Russia exposure here at Marathon, look, we manage some index products. It's part of the index. It's coming out of the index. Ex that, we have no Russia exposure. And so we're very proud of the fact that we were defensive as it relates to Russia. And, listen, Zelensky is the person of the year. And I think, teaches all the world leaders what it is to be brave and to have vision. And so watching him address Congress this morning to a standing ovation was amazing. But this is Putin's war, and Putin has turned Russia into a very difficult place to invest. Some characterize that as a pariah country, and we don't want to have any capital deployed in Russia. So there's other places for us to go. What I'd say is, you just look at what happened yesterday with the nationalization of all the airlines. And so there's 523 planes that the West, U.S. and European investors have unleashed with Russian airlines, and all those planes have been seized, all 523 of them. And then on top of that, Putin yesterday signed a decree to nationalize the Russian airlines. So which other industries is it also going to nationalize? Marathon has a nice-sized aircraft leasing business, and we don't have a single plane in Russia, not a single plane on lease to any Russian companies. And so I'd be very cautious with Russia. I don't think the West should be deploying capital there. And I think the defaults, and we talked about this earlier today on our call, with Euroclear and the freezing of and sanctions and regulations and the freezing of their capital, the Russian sovereign overseas, the default's going to be rolling in one after another after another. It'll take a few weeks yet, but sometime in the second half of the second quarter, so you're talking about May and June, you'll see default after default after default hit. As the West has characterized Russia as a pariah country.
Bruce, let's turn our attention to China. Chinese stocks are coming roaring back today after being battered for quite some time, but nevertheless a massive rally as the Chinese authorities seem to get in behind the Chinese asset markets and say that they have their back. What do you think about the Chinese economy? Are you allocating cash there? What do you think of it right now? And do you think a rally like we're seeing today has legs?
So yes, I think the rally has legs, but and I'll tell you why in just a second. So China's economy, asked about that, growing at 5%. The Chinese government is lowering rates, not raising rates. So they got ahead of that curve, and they're making those adjustments. And He, who's the vice premier to President Xi, came out and made some very bold statements today, and it's going to help Chinese tech Chinese economy, but he talked about the easing of regulation. He talked about we'll have to see what follows up with that, but the easing of regulation and the support that the Chinese government is now going to provide both markets as well as the economy. And he's very clear, Vice Premier He, who is the second in control in charge of all economic policy in China, was very clear to say not only the economy and housing, but markets. And so with that, ADRs have ripped. And I wouldn't want to be those folks that capitulated yesterday and the day before, selling their ADRs, selling their Chinese holdings in the hole, because I think we're in recovery mode. They came in very, very cheap on a valuation basis. And what you were worried about is geopolitical risk, and you were also worried about taking regulations which would further prohibit these companies from prospering, and they've come out and made some very bold statements they hadn't made in the past. So I think those folks that sold will definitely regret that. I think this move that we're seeing this morning will have legs, but this is the initial jump of that. It may retrace some of that, but over time I think it will improve as the Chinese government realizes that they don't want to destroy their private companies.
All right, Bruce, unfortunately, we have to leave it there. Time is always too short, but thank you for giving us your time this morning. That's Bruce Richards, Marathon Asset Management Chairman and CEO. This is Bloomberg.
Minds.
Keeping you up to date with news from around the world, here is the first word. I'm Justin Morton. South Korea says that North Korea's latest missile test appears